Good morning and welcome to the Saxo Bank morning call. It is Friday, June 28th, and this will be our final morning call in this format. We will continue with the morning call. We may have a summer break here, but it will be in a different format. Just be aware of that. But we'll get through today as per normal and see how it goes. So yesterday we're still all in anticipation. It's really tough, I think, to read how much the market is putting into expectations around this G20 meeting. We have a very elevated stock market. I have a chart here. It's not really any change over the previous days with that NASDAQ 100 pretty much elevated at the top of the range, a couple of indecisive days after that recent sell-off. Interesting to note, there's been a lot of, we talked a little bit earlier in the week about some of the divergences we've seen. We saw very weak small cap stocks. We saw the Dow Transports down as well. So suggesting that market breadth is not very good now as well. John Hussman of Hussman Funds was out with his monthly piece, and he has a pretty comprehensive look at market breadth and suggested that the market breadth is actually very bad right now. So interesting there. Also interesting that yesterday, even though the overall index did not do much, we saw the small caps actually bouncing very strongly. So I'm a bit clueless, I must admit. The signal's throwing off from the equity markets here, but the bond markets certainly had a good day. But before we get to that, you brought a slide here just showing some of the major market performance we've had this year so far.
Yeah, it should almost be a quarter in two halves, because if you look at this performance of different asset classes around the world, we can see how we generally finishing the quarter in more or less in the black or dark blue, apart from something which is like a rare earth, which obviously received a lot of attention back in May when the trade war escalated. And there was worry about China reducing exports to the US and so on.
That trade has faded a bit since then.
That has faded, and it's probably managed in the meantime to drag a lot of investors into this sector, because there was such a lot of focus on it. But generally, overall, we're finishing the quarter a lot better than how we started, and obviously that's all to do with how the Fed has been signaling or sending.
And the 9% year to date on emerging market bonds, just incredible performance in fixed income. And that is my next slide as well. The strong bounce back in Treasuries, to me, suggests at least some modicum of safe haven seeking here ahead of the G20 weekend. So that was interesting. We couldn't even do a decent consolidation. Of course, this all could change. I don't really have much to add to what I think is the consensus view, is that perhaps we're going to see some sort of restart of the talks or something that looks like a bit of a climb down or détente from the previous escalations. It would serve both sides' interests. Stability from the Chinese side, the election campaign and the stock market from Trump's side. But interesting, we saw that one of the headlines we're seeing is that China is insisting that that the U.S. side cease in its sanctions against Huawei. So I think it's very tough, given that this whole Huawei issue goes to the core of what the really long-term risks are in the U.S.-China relationship. The risks to technology and national interest and intellectual property and national security. It's going to be that's a tough ask, I think, from the U.S. side. So that'd be very interesting to see what comes out of this meeting. Of course, be primed for following that over the weekend and for the Monday Open, because of course we could have something that looks a bit promising, but I think the risks are very asymmetric. We could have something very promising as the market expects, or we could have something that looks like a disaster and the worst outcome for markets the markets are prepared for.
And we did see last time in Argentina that when you're standing face to face, you tend to be a little bit less aggressive than when you're sitting behind your computer writing tweets.
Yeah, that was a key meeting, that lunchtime meeting, and
so again, potentially some initial positive vibes coming out, but again, the mountain that needs to be climbed is still huge.
That's right. So we had the strong session from Treasuries, and it was an interesting piece out. You can find some of the points on zero hedge from Albert Edwards of Societe Generale, I would argue the king bear out there among market observers on the equity market or on the state of the economy, etc. But he's talking about the final thing we need to look for is the yield curve steepening, actually, as a sign that the Fed is having to throw in the towel and is having to react to a badly stumbling economy. So far we've seen the inversion full inversion has taken place for the 3-month to 10-year. We see that in blue here on the chart. You can actually see that it's actually headed below zero, has traded down as far as, I think it was minus 25 basis points as extreme. We never quite got there on the 2s, 10s. I doubt if we have a chance to get there because the Fed is going to start cutting. But you're seeing a little bit of steepening for the 2s, 10 2s, and not yet on, but not quite enough to suggest that the Fed is panicking. So that'll be one that's interesting to watch. That yield curve steepening usually coincides with, again, the Fed throwing in the towel and some really ugly data coming out, fears of recession, and ugly equity markets. So we'll be on the lookout for that. The other key market we've been watching here is, of course, gold, the big move above 1375, that resistance. We're in a consolidation phase. Ola, there's not a whole lot to add, but you're arguing we should be looking at this weekly bar for interest.
Yeah, I think we have to, but I think the bounce we've seen overnight in gold is just the same as we're seeing in bonds. We're seeing some precautionary trading ahead of the G20.
Very volatile. I thought it started. I was like $10 off the highs overnight. So
yeah, it
has jumpy.
It is very jumpy right now, and but so far we managed to hold the 1400 level. That's well ahead of the first major level of support, which you mentioned, John, 1375, also 1380 going back years. So we got an interesting setup for next week. But just take a look at the bar there. If we close down closer to 1400, it's not a pretty bar in the week, and that obviously creates some technical nervousness as we head into the next one. So again, all eyes on the G20 this weekend.
Yes, yeah. So a positive outcome there, positive for risk. Treasury sell-off, yen consolidates. We would probably expect to be testing those key support levels in gold as well, I would suspect.
Well, just have to add, overall our view is still Fed is going to cut. He's probably going to cut more than the market believes at this stage. So that's why I think there's still an underlying story for gold. So even
definitely
see it correct. So we're seeing this as a correction, and as a buying opportunity, not a reversal.
Right, exactly. So, and that brings us to Dalia yen, a similar chart, but upside down for Dalia yen. Tactically interesting that we managed to steer away from that 108 level. I would argue 108 in Dalia yen is a little bit akin to 1400 in gold. And if we're going to be probing lower in gold and in treasury yields, then we're going to maybe retrace a bit back towards the next key area, which comes in ahead of 109. But as you can see, quite a bear market has developed there. And again, similar to gold, Dalia yen, the upside down story there. Looking for places to get in on the short side and where we're going to find resistance, whether it's this lower level or not, for maybe a one rung higher on the ladder there. Also in FX, one of the interesting things ahead of the weekend is the revival in the Aussie. We see our chart here, that 70 level has come into play. 70 is a psychological level. I would argue maybe the level around the weekly close. You can see the nominal local high was just above there, 70.22 or 23. And the 200-day moving average is maybe a little bit more interesting if you look at that. We've almost touched it and actually touched it 3 times since late 2018. So yeah, some slightly more friendly outcome to the G20 here. We could see a squeeze. There is quite a large speculative short, but not starting to do real damage to the chart, I think, until we get to 71 and above on Aussie. We have a very strong iron ore market. That's onshore in China that's driving Australian mining stocks to close to record highs. Finally, on the FX front, we have sterling continuing to stumble, actually making marginal, well, not quite new lows, but near the lows for the cycle against the euro. I have a euro sterling chart here for perspective. The technicians looking for divergent momentum have seen something like triple, even quadruple divergence there, but it's not seen anything interesting to the downside yet. The latest thing driving sterling to the downside apparently is Boris Johnson taking an aggressive stance on maintaining the ability to force a hard Brexit if needed as a key negotiating point with the EU. He's arguing, and I think rightly so, that if the UK unilaterally takes away its own option of forcing a hard Brexit, it does not become a tool in negotiations, and therefore the UK has less sway in those negotiations. So he's talking about, I think it's called proroguing Parliament if necessary to force a hard Brexit if the terms are not being met in his arguments here and obviously raising the risks that the market sees of a hard Brexit. We have a long-term constructive stance on sterling, but again, this could go anywhere in the near term. The key thing, 90 to 91 is sort of the last zone there in the euro sterling chart. Before we get to the calendar, Ola, we've got crude just sort of pausing, and we had that huge rally and then a very large sell-off, and we've almost exactly retraced to halfway. What are we?
Yeah, now I think the chart tells us all. We have a lot of compression here in terms of moving averages and just generally a lot of traffic here, just in between this 58.50 and 60.50 range. And it's happening just as we head into a couple of days, which could set the tone for crude oil over the coming months. OPEC meeting next week and G20 at the weekend. G20 will be focusing on demand because it's potentially growth related given the trade talks, and OPEC where it focuses on supply. So I think these I'm not as much a technical expert as you, John, but I think this is setting up for a potential sharp move next week. But obviously at this moment it's a coin toss.
needs to break one way or the other. It's certainly been all over the map the last couple of months.
Yep.
Very busy calendar. Not so much today. We have a lot of items on the calendar for today, but next week is, and over the weekend, of course, with the G20 meeting, or it's not even the G20 meeting, it's really just the Xi-Trump meeting, of course, that we're looking at there. We have a bit to distract us today. The latest Eurozone flash CPI data and the Chicago PMI is the final regional PMI survey. There's some that argue that these regional PMIs, even though they've been a bit weak, may not necessarily mean a weak ISM manufacturing, and really it's the ISM non-manufacturing next Wednesday that I keep a closer eye on for the general state of the U.S. economy. But over the weekend, we have the official Chinese manufacturing and non-manufacturing PMIs, and then that EU emergency meeting. It's all related to appointing a somehow I've left off the Xi-Trump summit over the weekend. Of course, that is Saturday, so keep that in mind. Very important, and the most important item that is not even on the calendar. And then the EU emergency meeting for the Commission posts, watching that argument with interest. And then note, I've highlighted in blue, the U.S. Vice Chairman, Fed Vice Chairman Clarida. He's considered a leading voice on the Fed direction here, perhaps more so than Powell himself. So keep an eye on that meeting. We have another speaker out later in the week, Williams, as well. And these are two voices that are quite influential. Then we have an Australian RBA cash target meeting. They're going to cut rates to 1%. What is the guidance from there? We've seen a little bit of an edge on from Lowe that he would like to. He's not a big fan of zero rates, and that could be interesting for the market that is anticipating they're going to continue to go lower, and he may push back against that, saying that we don't want to go lower, we'd rather see the fiscal side pick up. Then the rest, of course, the employment figures. A lot of these, the last key data, I think, cycle-wise, ahead of that July FOMC meeting, and input on whether they're going to go 25 basis points or 50 basis points.
Can I just highlight as well, John, that 4 o'clock this afternoon GMT, so 6 o'clock CET, we have the acreage and stock report from the U.S. government in terms of for the grain market. So that could potentially be a market mover there. So look out for that one.
All right, that's it for this series of Saxo Bank Morning Calls. We thank you for joining us. Do look, we will continue with the format in some way, shape, or form from here. There may be a small hiatus here over the summer, but stay tuned for that, and we wish you the best of luck with your trading. And until next time, thanks for joining.